Welcome to the Money and Mortgages podcast. I'm your host, Adam Coleman, Accredited Financial Counselor and Mortgage Planner. Join me as I speak with fellow industry experts on all things personal finance. Welcome, everyone. This is your host, Adam Coleman, and with me today, I have Certified Financial Planner Jen Swindler. Today, we're going to be talking all about navigating debt and all the different methods that people can consider when managing their debt, and really just trying to pay it off as wisely as possible. So in addition to being a certified financial planner, which obviously gives you a wide range of comprehensive financial planning knowledge, I wanted to have Jen on here just because she's also an accredited financial counselor and also a certified divorce financial analyst. So I think she tends to have a little bit more of a focus sometimes on the budgeting and managing debt, as opposed to some of the financial planners that are strictly high net worth investors. So I think this will be really good. So Jen, welcome to the show.
Thank you for having me. It's great to be here.
Absolutely. Well, I guess jumping right in, can you give a quick overview on kind of where debt plays into the overall financial planning process for you? Like, where are you focusing and what are the major considerations that you're having in the back of your mind?
Yeah, so most people are going to have debt of some form, whether it's just a mortgage or maybe it's student loans and credit cards or other things as well. But usually there's some planning component where we have to consider debt. And with debt being really a two-part expense, being the principal and the interest, that can be sometimes more straightforward, like with a loan or a mortgage, where generally you're going to just have that fixed payment over the period of time. But then with variable loans or credit cards, it can be a little bit more complicated to plan for because they're changing, and like we've seen over the past couple of years, become increasingly expensive. And so people's budgets might be constantly adjusting to basically accommodate for those increased payments or trying to pay those cards off more rapidly. So for most people, it's building that into their budget and into the financial planning software, usually to make sure that we're not overlooking it, since it can be pretty significant.
There's obviously big spectrums of debt. So I don't want to say there's good debt and bad debt, but there kind of is. So I guess, how do you differentiate between the really bad debt and maybe the not so bad debt in your mind? Is it mostly interest rate driven, or is there more to it in your mind?
I think there's more to it in that a mortgage, that comes with an asset. So it's not just purely debt that doesn't have anything behind it, really. With a credit card, where maybe you've bought something with that, but generally you can't return all your purchases to pay off your credit card debt. And so I think those unsecured debts, even though something might not get taken from you if you can't pay them, those unsecured debts usually don't tie to an asset or have any purpose necessarily. So I think those are generally going to be worse, and they're also usually going to come with the higher interest rates. But yeah, I think it's important to look at interest rates, but with mortgages, it's also, even though people are getting higher rates right now, they're usually going to itemize their taxes maybe for the first couple of years, which reduces that effective rate as well. So I think there's more nuance than purely interest rates, but I think that's a good thing to start out with for most people planning for debt.
How do you kind of rank them? Like, what do you consider? Obviously, I think we can all understand that consumer debt, like credit card debt, is the worst in most cases. There's not a lot worse than that we run across. Where do you fit in with certain types of student loans or personal loans? You mentioned the mortgages, but what about home equity lines of credit or second mortgages, things like that?
Yeah, and I think with the home equity line of credits, I think it definitely depends on, those are usually variable more often than not. And then, so those can get pretty expensive as well. And I think it depends if you're using it for qualified home improvement expenses, where you can also deduct that interest. I think that makes a difference there. I think that federal debt is one that people, maybe they owe back taxes or federal student loans. I think those can be really high priority debts, because if you don't make those payments, the federal government can garnish your wages. And so those are ones where skipping a credit card payment could impact your credit score negatively and have an impact there. But the federal debt of any kind can cause pretty severe consequences. And so I think, as far as like ranking, I'd look at whether there's a federal loan or those secured debts are important to pay, because if you don't, you can lose the asset. But yeah, generally, I guess for most people, we list it out in the interest rate order, kind of exclude the mortgage from it, and just pay them by interest rate.
Right. Okay. Well, and yeah, and that brings up a good differentiation thing, because I think what you and I mostly deal with are people that have enough disposable income to at least pay off the debts. It's a whole different ballgame when you're legitimately concerned that you're going to have your car repossessed or wages garnished. The priority certainly changes a little bit in that situation. So for this conversation, it's typically, all right, you're just trying to pay off debts in a manageable way. You've got disposable income, or you're hoping to get disposable income, kind of which ones to prioritize there. So that certainly makes sense. The HELOC, yeah, having that variable, I certainly tend to agree that most people tend to not use them for tax deductible purposes, it seems like, even though I think most people think that they're tax deductible in every situation, but that's not always the case. Do you differentiate student loans based on like federal student loans versus private, or do you really get that granular with it, or do you lump it all into the same bucket?
I try to get pretty granular with that planning. So private loans, I have quite a few people with private loans, and a lot of those are variable. And so
Right.
that can be something where, like those ones, a lot of the people I'm working with right now, they're in the 8 to 9% range on their private loans. So those have become pretty high priority due to the variable interest rate. But yeah, the federal, and then with the federal having the different programs like the COVID forbearance where people didn't have to pay for a few years, and possible loan forgiveness. And then there's also the public service loan forgiveness. Depending on the situation, it might be something where people want to pay a lot less towards those, or sometimes they could be on the income driven repayment that could make it so they have more space to put money towards other things. So as long as they're able to make the minimum payment they're required to on the federal loans, I actually probably more often opt for paying off private loans faster, since there's not really any of those advantages.
Right. You're not going to ever have those forgiven at that point. So you might as well focus on the other ones first. So, well, that makes sense. So I guess lumping most everything kind of into just the general bad debt bucket that we're talking about, the high interest rate, I guess, where does that fit in the overall financial order of operations that you think of? So like a lot of people talk about company matches, where to do emergency funds, when to do actually paying off debt. What's your order that you typically like to see?
I usually like people to get about a month's worth of an emergency fund set up just for that security. I think peace of mind, if something happens, they're not just going to end up spending everything on credit anyway. So I would go for about a month of emergency fund, pay off high rate debt. And usually I look at that over 5%, maybe excluding mortgages and maybe excluding certain federal loans, depending on their situation. But yeah, generally in order of interest rate. And then once they've knocked out the higher interest rate debt, then I'd kind of go back to emergency fund. But the 401k piece, that also depends on the situation. But if somebody's getting a 100% match, if they do 2 or 3% contribution, I usually think that's worth it, because they're going to get that 100% rate of return, which is still a little bit better than what they're paying on their interest rate for their credit cards. But then some clients have 25% match, and so their credit card might be 30%, and maybe that's not really worth it either. Or maybe they're not planning on working there very long, and their vesting schedule's several years out, and if they're not really going to end up taking that match with them when they leave, the credit cards are probably a bigger priority.
That's one I don't feel like a lot of people mention. Like it's always cut and dry, like, oh, you need the company match because it's free money, but then they don't talk about the vesting schedule. And I think a lot of people don't factor that in, which I think that's a good point, is yeah, if you're not getting fully vested for another 3 or 4 years and you don't plan on staying there for that long, that really changes the dynamic of that quite a bit, in which case you're probably better off just going with credit card debt and paying that off first. So that's definitely a good point. Where are your thoughts on debt consolidation? Because that's kind of a topic where some people I feel like are all for it from a math standpoint. I think it makes sense. But then the question is this specifically a math question, or is there more to it? So what are your thoughts there?
Yeah, I mean, I think it's definitely more than a math question. And sometimes the math is actually worse, like with student loans, it rounds up their average interest rate a little bit. So sometimes they end up with a little bit of a higher rate, but maybe a more manageable payment. So sometimes the math makes sense there. Sometimes they can get a lower rate than their average rate if it's a bunch of credit cards that's going to a personal loan. But I think that it really comes down to someone's habits, where I had somebody not too long ago where just really struggling with credit cards and felt that it was going to be helpful to do the consolidation loan. And at first it made a difference initially for a couple months, but then kind of fell back on those old habits of using the credit cards and ran up those balances again. And so in that case, it wasn't really helpful because I feel like it just enabled them to clear out those credit cards and then re-spend that money again and end up with more debt down the road than they might have had. So I think that's something that it's hard to gauge because I think people always have the best intentions of paying off their debt and they don't think they're going to do that. And most people are going to tell me that the consolidation loan sounds great. It sounds like it's going to help them. And then they haven't made those habit changes yet though. So I think that I don't really like doing them if I haven't seen a habit change first. Otherwise, I think it can get people in a worse spot afterwards.
What does that kind of look like from your perspective? Do you usually try to have them do the habit change before and then adjust or see some sort of positive change in their budgeting or their spending and then do the debt consolidation?
Yeah, I think it looks like stopping use of credit cards usually, where like living off of their actual cash. And especially if they're, making all their payments, maybe paying a little bit of extra towards credit cards. But yeah, I think discontinuing the use of credit cards and then not spending on totally discretionary things left and right. I think there's always going to be some level of discretionary spending. But yeah, I think in that case, it was somebody who was still just continuing to do a lot of discretionary spending. And I think it should have probably been more clear to me that those habits hadn't changed enough yet to be worth it.
Right. Is that kind of the same logic behind kind of playing the credit card game where you're transferring credit card balances to try to take advantage of promotional rates? Is it still more of a Band-Aid and not solving the underlying issue, or do you treat those differently?
I think it's quite similar. If somebody is really struggling with a lot of high balances on a lot of credit cards, I don't usually see them getting very good limits on those 0% cards anyway. And so I think usually people have to have made some pretty good effort to be paying down their debts and at least getting things further away from their overall limits. And they have to generally be having better habits, I think, to get those options. But I have seen that one, the 0%, I think has typically been a more effective thing for a lot of people because sometimes it's just this, this card is just so difficult to pay off. They're really working on it, but then just feels like this losing battle. And so, yeah, sometimes in those cases where it's like their credit score is good, they've been making a lot of effort, but it's just costing them a lot of interest every month. And so in those cases, lots of times we might move it over to a 0% card and then make sure it's going to be doable to pay, let's say it's a 12-month card or 18-month card, make sure that they can do it in equal payments over that 12 or 18 months and that it's definitely going to be paid off by the end of the 0% term. And if that's all doable, then yeah, usually I've seen that work out really well for my clients.
So one other thing would be debt settlement. So not debt consolidation, but debt settlement companies. There's a ton of bad ones out there. Have you dealt with any good ones that you actually trust and you think that they actually are successful, or are they usually ones that you kind of steer away from?
I usually avoid that route. I've seen them be pretty aggressive and there's a lot of fraud in that space for sure, and a lot of people that get taken advantage of. So yeah, I'm sure there are reputable companies, none that come to mind that I've seen, I guess, personally, but yeah, I think that with
I haven't either. So
sometimes it can take so many years anyway, and it can still be really expensive. Sometimes it's still in the 15 to 20% range. And so I think usually consolidation first, if somebody can do that, or trying to pay things down till they get to a point where their credit's better, where they have more options. Even bankruptcy in some cases might be better, because if it's going to be just this years-long thing and it's going to cost them a lot of money, maybe impact their credit, then in some cases bankruptcy could actually be just a better way out of it for people. So
when does that become a viable option in your opinion? Because that's a good question. I did want to kind of ask about that. So where do you see that? Is there a certain dollar figure that you kind of use as a rule of thumb?
Maybe this isn't even true, but I would think if somebody has debt below like 50,000, I think there are probably more options available. But then again, when I worked in a counseling center, I recommended somebody declare bankruptcy and they had something like 30,000, but they had no income, they had no ability to make enough to pay it off. They had done a bunch of 0% cards that had done the retroactive interest. And so just all these cards way over the limits, they were just getting hit with monthly fees, and it just kept climbing and climbing. And it just felt like at the point I saw them, they were about 30,000 in debt, but it was definitely going to keep getting worse. And there were also some other student loans that were private, so those would be discharged in bankruptcy. But yeah, I think when it gets to the point where there really aren't options anymore, and it's going to cause significant damage to someone's credit anyway, they're probably not going to qualify for anything for quite a period of time as it is, then those are kind of the drawbacks of bankruptcy, is the damage to credit and the amount of time before you can qualify for other financing. And that can be very similar to what happens when you get into a situation where you're not able to make payments anymore and it's just snowballing out of control. So
Right. Yeah, I was curious what your thoughts were. A lot of it just depends on disposable income as well. If they have any potential of paying it off, some people don't, and then that's really their last resort. So where does like 401k loans fit in to that? Like, do you ever see those as a viable option for anything at this stage, or do you try to steer away from any kind of 401k loan?
yeah, no, they can still be a good option, and similar to a consolidation loan, where I think the habit changes should happen first before going down that avenue. But because there have been some better changes made in the past, they were worse for people, where sometimes they couldn't contribute until the loan was paid off, or sometimes there were certain benefits lost. But now for most people, they can still do their normal contributions, still get their normal employer match, and they can make payments towards their 401k loan at the same time. And then that interest goes back into their own account rather than being paid into an institution. So I think for some people that makes sense. I mean, they're foregoing the investment growth, and that's the main, basically like the drawback potentially. But yeah, for some people, if they have a large 401k, it's going to wipe out all their high interest rate debt, and then they're going to have one payment that's going back into their own 401k. I think that one's, for whatever reason, I think pretty generally motivating for people to want to pay off, and because if they leave their job, they have to pay it back in full usually. So I think it's one where I've usually seen those ones work out if those habit changes have happened first. Sometimes, people just use it as like another credit card or a way to spend money, and obviously that's not ideal. But
no, definitely not the right route to take on that. And that brings up another thing, is obviously if there's a chance that you're obviously leaving that job, that puts that into a different category, because then you have to pay that back basically immediately. So that screws everything up for the debt consolidation piece. Unfortunately, then you have to find another viable option for that afterwards, which is probably not ideal. So we mentioned focusing on the debt pay down things. There's obviously two big methods. You get the debt snowball or the debt avalanche, or whatever you want to call it. There's a bunch of different ways, but snowball designed to focus on smaller debts first, build some sort of snowball effect, and then hit the larger balances afterwards. Avalanche is obviously more higher interest rate first, and then down just based on pure mathematics. Which do you tend to advise, and then which one do you see as most effective in your world?
I usually do go with the avalanche method, and I think it's mostly because, and as when I put things into a tool showing the debts and what's going to happen, lots of times just switching between those two methods, sometimes it's thousands of dollars. And so I think the amount of money, especially showing that to people, because I think what the biggest argument for the snowball method is that it's psychologically beneficial to pay off a debt and feel good about it. But I think showing people the difference of those two numbers is often still a pretty good psychological motivator of knowing the difference between what the debt's going to cost on this method versus the other. But I mean, I do think there are cases where maybe there's like a couple of small, we have somebody who's about to pay off a personal loan that had an $800 monthly payment. And so for them, it makes sense to just get rid of that, have all of that extra money to put towards other cards, even though the rate is lower on the personal loan. But yeah, so I mean, I think there's still cases where it can make sense to get rid of some of those small ones, and I make it simpler and have a little bit more freed up cash flow. But I generally would, if all the loan balances were like somewhat going to take similar amount of time to pay off, I'd probably go with the avalanche method instead.
Yeah, I feel like that's how I didn't tend to advise or guide, it's usually like throw it into buckets. Is like, all right, if all these interest rates are somewhat similar, but then this balance is way lower than the other ones, just focus on the smaller balance and do it that way, but still somewhat regimented based on interest rate. But it doesn't have to be perfect in terms of exactly the highest interest rate first. I think that's the nuance that I think is most successful. Are you typically just using some kind of Excel document to compare those, or is there other sets of tools that you use to compare debt pay down strategies on your side?
Yeah, so I mean, it's usually a combination of Excel. There's a guy who's created a bunch of really good spreadsheets, and it's called Vertex. And you can just, yeah, if you've seen those, downloading those are really nice. Then there's like the Dinky Town tools. I think those are pretty good.
Yeah.
And although I was going to mention, I just had the thought on the like order of pay down though, that sometimes if it's a case where someone's credit score is low and they're really needing to get that score to a certain point, sometimes I also look at the utilization ratio of that card.
Yep.
And sometimes we'll pay down the card that's maybe like at a 90% utilization, because that sometimes will have a really big impact on their score, kind of regardless of interest rate. So I think that's also another component too. If it's like urgent to get a score up as fast as possible, then sometimes there's that third option that's good to consider as well.
True. That's definitely a good distinction. And especially if they're trying to apply for anything, mortgage, car loan, anything like that, that plays such a big factor into it. Because really paying down a personal loan or an installment loan does nothing positive for you. At that point with your credit, it doesn't factor that into the equation. It's just on-time payments. So if you're paying extra, it doesn't help you. But paying extra towards the credit card, reducing that revolving limit is a huge benefit and could be a massive increase to your credit score, which obviously then saves you money on whatever, car payment, mortgage payment, insurance, which hopefully then snowballs into more debt being paid on. So that's definitely smart. I agree with that. So yeah, and I like the Vertex as well. I actually use their debt pay down one straight through that website. There's like a snowball versus avalanche. And I think that's a really good tool. That's all good stuff. Does any of this change, I guess? I think in the back of my mind, I'm thinking for a lot of people that are going through this, they're typically on maybe the younger side or middle-aged side that are going through accumulation, but that's probably an incorrect stereotype to have at this stage. So everybody has debt, including people that are retired as well. So does any advice shift whether they're kind of younger on the accumulating asset side versus retirement withdrawal strategy side in terms of debt pay down strategies?
Probably not dramatically. I mean, people who are in the accumulation phase, they're maybe going to be more aggressive with investments, maybe get a better rate of return. Maybe it's more like, if they have a 5 or 6% debt, but they're a really aggressive investor, like maybe they don't need to pay down that debt as quickly. Whereas somebody who's in retirement who maybe is aiming for that rate of 5 or 6% rate of return, the debt would be hurting them more potentially than foregoing investing. And it'd be maybe something too where a 401k loan might be better for someone who's older, because that growth on the investment might not be as essential or might not be as powerful basically at that point in time. And so
true.
That could be a better way to pay off debt later on. You probably also have more available, or I mean, you can only take 50,000 at the most anyway for that. But yeah, I mean, it's something that they might be able to consolidate debt in a better way if you're in retirement or close to retirement compared to somebody who maybe hasn't accumulated much in a 401k.
Do you focus more on having like mortgage debt and really any debt, I guess, paid off before retirement? Like, is that a big focus of yours, or does it really matter as much from your perspective?
I think that for a lot of people, that's a psychological thing. I think a lot of times if they get to a point where their rate on their mortgage is pretty low, then yeah, they might, if it's a 3% mortgage, then as long as they have the cash flow in retirement to keep paying it off, then letting their investments grow longer is probably going to be better. But I don't necessarily think it's a big deal unless it's really going to be difficult for them cash flow wise, or if they only are going to be living off of Social Security in a smaller retirement account, then maybe it's a more important thing to pay that debt off before retirement. But if they've saved a lot of money and they have the ability to pay it off over time, I'd probably still do that.
Right. Well, yeah, no, I was more thinking like, does it make sense to finance like a car or something that maybe is questionable in terms of good debt or bad debt, or if it's just better to pull it out of investments at that point if you're of retirement age. But then the thought is that you're still pulling it out of retirement, whether you do it annually or monthly or one time. So it probably is all mostly a trade-off at that stage. So probably not a big decision either way. I could certainly see where it could come into play if you're trying to keep your living expenses as low as possible for like really low tax bracket planning. But outside of that, it probably doesn't make much of a difference one way or the other. So I think a lot of people kind of harp on trying to pay off a mortgage before they retire, but then all these people tend to have like a 2.5% rate. So it's not usually that difficult to get that elsewhere. So I was curious what your thoughts were there, but no, this is great. Any other advice, I guess, for somebody kind of going down that path that has the debt? Like, what should their first step be? And I guess to this point, like, who should they talk to first if they did want advice? Because I know some financial planners don't necessarily gravitate towards that topic. Do you tend to think that that's where a financial coach comes into play, or do you think still more going along with financial planning just because it's comprehensive? Which route do you think usually works better for people?
Yes, I guess if they're wanting to do something on their own, then the first thing I'd just taking inventory of everything. Sometimes that's something that people haven't done. And so I think listing out all the debts, all the interest rates, all the minimum payments, and then all their assets and figuring out maybe what they have available each month to put towards different debts. I think if someone's going to do it on their own, that's really important. And most people who come to me haven't taken that step yet.
Right.
But then, yeah, if you want to work with a professional, I do think that people who have the AFC designation are generally going to be more likely to work with people who are trying to work on paying off debt.
Right.
I mean, definitely there are a lot more of like the advisors who charge fees the way I do, where it's a flat monthly fee. A lot of people in that space are more likely to work with people paying off debt because there's not an asset minimum.
Right.
That's something I get, like an old advisor I worked with a prior job reaches out and sends me people who are in those situations if they can afford my monthly fee, but don't have maybe the asset minimum that's needed to work with a traditional firm. So I would say
Right.
though, any place with an asset minimum is really not going to typically have much focus on that.
That's not going to work. So
Yeah. So, but yeah, I mean, I think the AFC, like searching on the AFC site, that's, I think, a pretty easy way to find somebody to see if they do work with debt, and then trying to find somebody who's charging maybe a flat fee that's affordable
right.
to the person's situation. But
yeah, no, I think that's great advice. I think I would start there as well. And they've got a good find an AFC search. You can basically plug it into your area. So, well, Jen, this has been a pleasure. What if somebody wants to learn more about you? What's the best place to?
well, my site is under construction right now, but it's money-illustrated.com and should be up in a couple months. But yeah, people can add me on LinkedIn and send me a message or something until that point. But
Yeah, no, that's perfect. Well, this has been great. I really appreciate you taking the time. It's always a pleasure.
yeah, thank you so much for having me.
All right. Thanks, Jen.